Namaskaram, everyone. Let's get started with our today's session. Today's session is about capital project appraisal. And why is it very, very important from an actuarial perspective? What goes into capital project appraisal and why is it important from an actuary's perspective? So, to do that, first let's understand some basic foundations of capital project appraisal. The first of that foundation is what are the capital investment decision in any organization? Capital itself means substantial financial resources, long term. So when you say I'm taking a capital investment decision, I am actually committing a very huge amount of financial resources, right? Which is a significant amount of financial resources, primarily for the projects which have a long-term life as such. And the intention is today I'm investing in them so that they give me various economic benefits in the future. I'm investing in them today so that I can get economic benefits in the future. So there is a huge capital, huge money that is involved. Today we are investing with an anticipation that over the next few years, we will be generating some economic benefits out of that investment. So, which means in capital projects, you will have very large initial cash outflow, whereas the benefits will be coming over the next several years. Right? Largely, you will have a big cash outflow right now in the year zero, but probably in the future dates, you might expect some huge, some benefits spread across multiple years as such. And most of these decisions are strategic and they are irreversible. Once you have taken a decision, you cannot change that decision that easily. Right? If you are changing means you would be incurring some kind of sunk cost. You will have to forget that cost that you have spent on it till now and you have to start again from scratch. So that's where a lot of thinking has to go into this kind of projects. Generally, the projects that are influencing the capacity of the firm. So it's more like expansion related projects, right? Should I go for new location? Should I go for a new building, new plant, etc., etc.? Or they would also influence the competitiveness of this company vis-a-vis the competitors. And overall operational structure also is getting influenced by these projects. And as I have already indicated, most of these investments, they have a long planning horizon. It's not that they will be addressed in, the benefits will not be coming immediately. Generally, the benefits will spread over good number of years. So they have a very long planning horizon. And there is a lot of uncertainty about the outcomes that might come up in the future. This is how you will understand the capital investment decision. So, probably, quickly to summarize, they will have a long term impact on the financial performance of the organization. And because of that, they need to be given enough thought before acting on them. They involve a very huge capital investment immediate upfront. Upfront, they require a very huge capital investment. And because of that, also, there has to be a lot of planning and commitment. And there is a lot of uncertainty, which means the profile of this is very, very complex, the risk profile. Right, there could be all types of financial risk, the market related risk, operational risk, regulatory risk. So the risk profile is going to be very, very complex. And there is also a possibility of interdependence with other projects and strategic initiatives of the organization, which also makes it even more complicated. One wrong decision might even impact the multiple projects as well. So, from a decision making perspective, you should be focusing upon how do I forecast the future cash flows, both inflows as well as outflows. What should be the cost of capital that I should use for discounting the future cash flows to arrive at the present value of the money, of the cash flows? And all the evaluation metrics have to be risk adjusted. Risk adjusted return needs to be computed. Now, why are we talking about these kind of projects in the context of actuaries? So probably there are many projects which actuaries are involved in, which are related to infrastructure investments, upgradation of the IT systems, right? Platform related launchings or any regulatory capital related improvement projects, etc., etc. All these generally are pretty long term kind of projects, and they would very much expect a huge investment in the capital. So, looking at this kind of a dimension, it makes very, very important sense to look at the fundamentals of capital projects or capital investment decisions, and accordingly consider the various mechanisms on how do you evaluate these kind of projects, how do you assess these kind of projects, what kind of actions that you can take care with them. Now, what is the role of capital project appraisal in financial risk management? When you are using the word appraisal, it is a systematic evaluation to determine of the various investment opportunities that we are going to have, to determine whether that particular investment that I am making in any project is financially viable or not, and at the same time, what is the level of strategic suitability associated with that project. So there are two things that we are looking at. One is primarily the financial viability, and two is how much strategically this particular project is suitable to the organization. And because at the end of the day, we are always working with scarce capital resources, and we want to ensure efficient allocation of these scarce capital resources among all the competing projects, because we are our resources are limited, but our the number of projects that could be there could be larger. So I should be in a position to allot my resources appropriately across the different competing projects. So this whole exercise of capital project appraisal, it integrates financial analysis with the enterprise risk management framework, and that's the reason we need to understand it much more from a detailed perspective. So it would really, for every investment, it looks at these two dimensions. What are the returns that you expect from each of these investments? And probably you would also look at what is the risk exposure associated with the cash flows associated with this. And overall, you can get into financial discipline by ensuring that the investments exceed the required rate of return. So, whatever the actual return that these tools typically provide, it is pretty much possible that I mean, when you are doing capital project appraisal, the intention is whatever the investment that you are making, it would exceed the return that you are getting on the investments, it would exceed the required rate of return. Okay, so basically, in actuarial practice, when you are doing any capital project appraisal, you are actually taking capital allocation decisions in insurance companies, evaluation of technology or product development projects, assessing the regulatory capital efficiency under the various solvency frameworks, etc., etc. That is the role of capital project appraisal in financial and risk management areas. Now, what are the types of capital projects that you can think of? This is another important dimension for us to understand. So we have expansion related projects. So where you are increasing the production capacity, or probably some kind of a geographical expansion, market, new entering into new markets, entering into new segments. That is, they're all expansion related projects. Opening of new branches, expanding all the manufacturing facilities, launching the new product line. So here you are aiming to capture the growth opportunities and accordingly you want to increase your revenue. That's the first kind of capital project. The second kind is replacement. Your assets have become obsolete, they have become inefficient. So you want to bring in new technology, you want to bring in new equipment so that you can perform better by replacing the old ones with the new. And because of that, you may want to reduce your operational costs, and because of that, you may want to improve your productivity, enhance the reliability, etc. So, whatever example wise you look at your existing IT architecture, you may feel, I mean, IT infrastructure, you may feel that this is very much outdated. You may want to replace it. And accordingly, you may want to take it up as a capital project as such. That's the second kind of capital projects which are commonly found. Then the third kind is the regulatory project, right? There could be a few projects which you are forced to take up because you have to comply with the regulatory or legal kind of standards. So this may not be from the perspective of profit making, revenue increase, or any of such kind of stuff. But because you have to mandatorily meet the regulatory requirement, you may have to take up a few such kind of projects. Right. So whatever are the changes that you have to implement for bringing in data governance related regulations or Solvency II related regulations, IFRS 17. These kind of projects typically come as regulatory projects. Then you have a few strategic projects also, where the focus is on long-term competitive positioning or a business transformation. So something to do with innovation, something to do with digital transformation. So they will not generate any kind of immediate cash flows, but they can create some kind of a unique positioning for the organization. Even these kind of projects will come under capital projects as well. Right. Now, out of these, if you really look at this and this, the first and the second, they are revenue generating projects. Very clearly, they can generate additional revenue and overall contribute to the profitability of the organization. Even the strategic projects also, but they will contribute after a long time. Whereas compliance projects or strategic projects, they are more and more focusing on sustainability. Compliance is directly linked with sustainability. Strategic practices also, in a way, may be directly linked to sustainability and the overall risk management aspects as well. So that's how you have to understand the different types of capital projects. Then we have talked about it in our earlier classes as well, time value of money and the core principle of investment evaluation. I hope you are all comfortable with the concept of time value of money. A rupee that is available today is worth more than the same rupee that is available to me in the future date. The reason being that today's 1 rupee, I can invest it, I can deposit it in such a way that I'll get more than 1 rupee for my futuristic date as such. Right? So I can either deposit, I can either invest, I can either, and because of the inflation also, the value of my 1 rupee is going to increase drastically. And that concept of time value of money is purely based upon the opportunity cost of capital, right? How better I can utilize this capital, how well I have the alternate usages of this particular capital. The higher it is, the better it will be. And we also know if the inflation is much higher, the overall purchasing power of the individuals will go down altogether. And because of that, also the buying behavior will be different between today and the futuristic date. Now, this is the typical formula we all know from the discounting perspective or from compounding perspective. The future value is nothing but the present value times 1 plus r raised to the power n. Right? This is the typical future value formula. Or probably a future cash flows can be discounted to the present value, which is again just a opposite. PV equal to future value divided by 1 plus r to the power n. So cash flows, what is that? Why do we understand this concept of time value of money? Any cash flows that are occurring, so most of the time for different capital projects, your cash flows will keep occurring at different time periods. You may get some cash flow after 1 year, some after 2 years, some after 4 years, some after 5 years. You may get different cash flows at different time periods. You have to bring all of them, you have to convert all of them to one single common valuation date, right? And when you are doing this kind of a discounting, using the discounting formula, you can very well compare the cost that you are investing today with the benefits that you will be getting in future. Because even the future benefits, you will convert them to what is the equivalent to today's value. So equivalent to today's value, so you can get both the cost that is equivalent for today, the benefit that are equivalent for today. The difference between the two is going to give whether you are positive or negative. All modern capital appraisal techniques are based on this time value of money kind of a principle itself. We are going to talk about each of these techniques in our next upcoming slides as such. And here, one more important point we have to understand is the clear distinction between what is a cash flow and what is an accounting profit. So normally, if you look at any P&L statement of any company, you have revenues, right? And from the revenues, you take out the expenses. You call it as earnings before interest or profit before interest and taxes, right? And probably out of that, you subtract your interest. People call it profit before tax. You subtract taxes, you'll get profit after tax, which is what is called as accounting profit. I've put it in a very simplified terms. Probably here you will have something like depreciation. There are a few more entries that will come in here to give a more clarity, but I'm only talking about on a very, very broader note. So this kind of profit that comes from the financial statements, right? That is what is called accounting profit, derived from financial statement prepared under the accounting standards. Accounting standards will clearly tell us what is the way in which the data needs to be entered for a particular transaction. Right? That is what is the accounting standard. So, which means you are preparing the entire financial statement based on some accounting standards. And in this, there are, again, not getting too much into the accounting standards here, you will have a few entries like depreciation, amortization, which are actually the non-cash expenses. So, as a part of your expenses here, they would also include non-cash expenses like depreciation and amortization. And this number that you get, the PAT as a number, it is very much influenced by the accounting conventions and reporting policies, because different countries may have different accounting convention, and because of that also there will be some amount of subjectivity. So your final accounting profit, as I've shown, is nothing but majorly it's a difference between your revenues and expenses. Whereas when you talk about from an investment appraisal perspective, people are not bothered about what is the profit that you are generating. People are more bothered about the cash flow, because it is the actual, it's not accounting, it's not representation, it is actual. It's actual inflow or outflow of cash that is purely generated by the project, right? So obviously this kind of mechanism is much more important, much more feasible for evaluating whether I should invest in this particular project, whether this project is sustainable or not. Now, if I broadly have to pull out the differences, there are a few here. So the accounting profit actually is based on an accounting mechanism called accrual accounting, right? The revenue wise, you realize it only when you earn. Expense wise, you may note it only if it is incurred. So you could see that you will always see that the accrual accounting comes into picture in case of accounting profit, whereas in case of cash flows, the actual movement of the cash, irrespective of what is written in my accounting books, I don't care. What is the actual movement of cash that has occurred, both the inflow as well as the outflow? That is what is the difference from a basis perspective. In a depreciation, as I said, it's a non-cash expense, right? In case of accounting profit, that is typically taken as an expense and accommodated. Whereas here, we add it back because it is non-cash. We only focus on the cash-related movements inside and outside. Then the relevance of investment accounting profit to the investment related decisions is very, very limited, but it is going to be very, very critical when we work with the cash flows. And finally, the valuation models, they very heavily use cash flow based valuation rather than the accounting profit based valuation, right? Now you could clearly see here how are we deriving the cash flow. So if you really look at just these two, revenue minus operating costs, right? This is what you can very well try to work with. You can very well work with the accounting profit. Of that, not accounting profit, you can very well take it as a gross profit or something. You take out the taxes, you add back the depreciation, what you get is a net cash flow. Depending on whether it is positive or negative, it would be either be a positive cash flow or a negative cash flow. Right? Why are cash flows more important rather than the accounting related profit? One is any investor who is investing in any company, they want actual movement of cash. They are least bothered about how it is written in the accounting books, etc. Even the debt servicing, which is how much interest is typically being taken, how much is being paid, etc., etc. And even the dividend, the same thing, profits that are coming out of the business, they are paid in the form of dividend. So we are also trying to understand that the dividend should rely more on the cash availability. And that is how we understand the difference between cash flow versus the accounting profit related concept. Now let's try to understand if our concepts are clear by quickly checking on a few conceptual enablers. An insurance company is evaluating whether to implement a new actuarial modeling system that requires large upfront investment but is expected to reduce operational costs over the next 10 years. Which category best describes this project?
Replacement project.
whether to implement the new actuarial. So the existing system has to be reduced and reduce the overall operational cost. So it comes under the replacement project. You are right. As financial analyst evaluates a project using accounting profit rather than projected cash flows. Which key issue does this approach ignore? Which aspect does this approach ignore? Accounting profit versus the projected cash flows. Projected cash flows is about the cash flows is about actual movement of money, whereas accounting profit is as per the rules of denoting these numbers in the accounting books.
Liquidity and actual fund availability.
Right. So the actual fund that is available, is it available or not? So that is something that is very much taken care of in the cash flow statement, but the same is not taken into consideration when you are going with the accounting profit per se. Fair enough. So that is our first module as a part of capital project appraisal. In the second module, we would look at construction of the project cash flows. So the first part there is identifying the relevant cash flows, because you are creating the cash flows now. The first step is identify which cash flows are relevant for this construction exercise, right? So typically relevant as a word is nothing but, so whatever the cash flows that you will get in the future, whether it is in terms of inflows or outflows, only when the project is undertaken. Without undertaking the cost, without undertaking the project, I need not put up the costs or the revenues that I would be getting from the project. Now, in this context, we talk about incremental. What is incremental? You are already having your existing machinery wherein you are able to produce 100 units of a particular product, but because the new machine is going to be very attractive, it might produce 200 products. So which means the incremental is only 100 by going with this kind of an expansion project, by going with this kind of infrastructure project as such. Incremental. Future, obviously, there is some uncertainty. Cash flow based effects. So I should not consider the accounting related profit at any stage. My focus should always be on cash flows that are typically coming out, the net cash flows that are typically coming out of the investment in the project. So cash based effects only. So which means if I have to quickly summarize the major characteristics, one is they are future oriented. They are directly associated with the project only, right? By undertaking that project, what additional benefit we might get, what additional cost that might be incurred. And anything that is non-cash but accounting related, we will not consider them as a part of our cash flow statement. They might very well go as a part of the accounting profit, but as a part of cash flows, they will definitely not go into. Right. So basically, you look at some of the examples of relevant cash inflows, additional revenue generated by the project, cost savings due to efficiency improvement, residual value of the asset. All these are cash inflows to the business. Similarly, when you look at the outflows, the initial capital expenditure, any other additional operating expenses that are getting built up, some activities regarding the maintenance expenses, etc., relating to the project. Here, you will not consider sunk costs at all. Sunk cost is the cost that has already been incurred. So it does not really make any change to the overall project as such. In that case, those sunk costs are very much avoided. And you do not bother much about the allocated overheads that do not change because of the project as such. Now, we are also trying to use the concept of opportunity cost, right? So, if you are trying to invest in this particular project and not in the competing project, then it means that you are foregoing the alternative opportunities that are available to you to invest in different projects. That is where we are calling it as the operational costs, and you should typically consider the operational costs, right? And the relevant cash flows, they are the ones that typically form the basis of discounted cash flow analysis that you would be doing using the NPV, IRR kind of calculations as such. Now, as I told you earlier, also, here the focus is not on the actual cash flow. The focus is very much on the incremental cash flow, right? Now, if at all I am using the old machine and I see that it was producing 100 units per day, now with the new machine, if it can produce 150 units per day, then obviously you are saving some 50 units, you are producing some 50 units per day. That is what you will write as your cash flow when you are writing the projected cash flows and the associated profitability associated with these projects as such. The difference between the cash flows with the project and the cash flows without the project is what we are typically calling as the incremental cash flow. The cash flow with the project minus the cash flow without the project. Only the economic consequences of the investment decisions need to be evaluated. The operation, the supporting, the all these typical departments, they should be only uh, looking at the economic consequences of the investment decision only. Then a few additional points that need to be kept in mind are: one, additional revenues generated due to the project. You should very clearly mention that. Cost savings or additions, new projects, new costs. Then cannibalization effect is also very much possible. New products reduce the existing product sales, and the new product may be a new avatar of the existing product itself. So they may not add much of a value addition as necessary. and both of them can derive some kind of annual benefit, right? Annual benefit or annual costs that are coming out because of the various operational changes as such. And any incremental analysis that you are performing, you should not be more and more carried away with respect to the pre-existing fixed costs or things like that. So if a new insurance product increases revenue by 50 million but reduces revenue by from an existing product by 10 million, if the incremental revenue is 40 million, I mean, the incremental revenue in that case will be 40 million only because your revenue has gone down by 10 million. So that is where the most important key takeaway from this session is the presence of the incremental analysis rather than looking at the overall output in totality. We would always prefer some kind of incremental cash flows related principle itself, because project is primarily from the perspective of replacing the existing project and using the new infrastructure, new machinery, etc. etc. Now comes the actual construction part, right? So, initial investment, every year we generating some operating cash flow out of the investment, and there is something called terminal value. So these are the three stages at which the I mean across the complete project life cycle, these are the three stages that we typically talk of. One is the initial investment. As we discussed, capital projects require a huge initial investment. Initial investment is the day on which the project is typically started. That is what we call as time zero. Upfront capital expenditure to start the project. So you may have to buy some machinery, you may have to buy some technology, installation, setup costs, initial working capital requirement, etc. etc. So generally, your investment, initial investment will always be like it consists of the cost of the asset that you are either procuring or already procured. So it's a cost of the equipment asset. Then what is the cost associated with the installation, and what is the change in the net working capital. All these are contributing to the initial cash flows, initial investment. At the beginning of the project, what are the costs that are typically incurred in the project? Then the part two, the second component is about the operating cash flow during the entire project life cycle, right from 0 to 5 years. If I say this as a 5-year project, right from 0 to 5 years, we are talking about what are the maintenance related revenues, what are the maintenance related expenses that are occurring every year. So it could be in terms of revenues, of operating expenses, taxes, depreciation, all that stuff. Right. So normally what you say is the operating cash flow is nothing but revenue minus the operating costs. And from there you subtract the taxes also, but add back the depreciation to it. Whereas the other formula for operating cash flow is you take the earnings before interest and tax, which is otherwise called EBIT, multiply it with 1 minus of tax rate, multiplied with the and overall add up the depreciation value to it. Right. Overall, what is the annual economic benefit that this project typically generates? That is what we'll consider for the part 2. The part 3 typically talks about a terminal valuation at the end of the project, at the end of the life of the project. What is the kind of cash flows that you will receive? Right? Either you might sell off that asset and you might want to receive some cash flows from it. So there could be anything that can happen with respect to the terminal value. But that is the amount that you will receive at the time of closure of the project. So the first one is at the time of initiation of the project. The second one is during the execution of the project. And the third one is towards the end of the completion of the project. So you can get salvage value. You will sell off that asset, and whatever is the value you will get because of that sold off asset, that is what is your salvage value. You may get some tax benefit because you are disposing that asset, right? And you could also get something like recovery of the working capital as well. So that is totally called as terminal value. It is very, very critical in long-term actuarial projects, whether you are talking about technology platform investments or any infrastructure systems, etc. Yeah. The fourth important sub-point that I want to talk about here is the tax effect. Right? Now, when we look from the perspective of taxes, as we have discussed earlier, the profit before tax, and from there, if the taxes go off, the final profitability, right, is drastically different. Taxes significantly influence the profitability of the project and also the valuation of the project, because there also, when you are doing your cash flows as well, you will have to incur your taxes. You will have to include your taxes because that's also a physical amount that is being paid to the other party. Now, after tax economic impact is what should be incorporated into the cash flow statement. So what we say here, the taxable income is nothing but revenue minus operating cost minus depreciation. That is what is your taxable revenue and our taxable income. On that taxable income, you play a flat tax rate or some stay slabbed kind of a tax rate. And finally, you would typically come out with your taxes that are payable. Right? Now, if there is a depreciation to your asset, what is happening? Look at this scenario. Gross profit minus depreciation will give you, let's say, a net will give you a bit out of this I subtraction will give me a profit before tax, and T subtraction will give me profit after tax. Now you see all these are different components which can increase your tax or decrease your tax. Now if the depreciation is going much higher, if the depreciation is going much higher, what you can see is all other things remaining the same. your tax will be reduced because depreciation is higher, EBIT is lower. From there, PBT is lower. Taxes are always some percentage of the PBT. So, what you could typically see is your overall taxes are coming down. And that is what is called as a depreciation tax shield. Right? If higher is the depreciation that you are having, the taxable income will actually come down because of this kind of a equation that we are talking of. So the depreciation amount multiplied by tax rate is otherwise called tax shield. And this particular tax shield increases the effective port cash flow, because we also discussed that cash flow, if it is typically increased, then you could also attribute it to the depreciation tax shield as well. So from that perspective, you can also compute the operating cash flow, revenue minus expenses, whatever the profit margin that I am getting, I multiply it with the tax rate, or I multiply it with 1 minus the tax rate plus the depreciation into the tax rate. If I take that up, right, you can very well compute the operating cash flow altogether. Then we are also expected to understand working capital adjustments and the project life related assumption. What is working capital? Working capital is nothing but short-term funds that are required for the operational liquidity. What do you say here? The normal components of working capital are the inventory, how much amount is maintained by the company in the form of basic infrastructure, right? Or probably they can talk in terms of accounts receivables, all the people who have taken on installment, who have taken on credit. To what extent I can understand the different components of working capital is what is being talked about. Even the cash balances, to what extent they are available, and the less accountable space always is a constituent of the working capital. Now, net working capital is nothing but current assets minus the current liabilities. We all know this relationship, right? And there could be a few constraints on the projects as well. Many projects require an increase in the working capital at the start of the operations as such. That is what is about the working capital. Now, when you look at the cash flow treatment of the working capital, initial working capital is always like at the cash outflow of a project start. Changes in the working capital during the project life must be incorporated as cash flow adjustments. At the end of the project, working capital is fully recovered, creating a terminal window. So you could see that there is a cash outflow at the beginning of the project, then inflows or outflows alternatively differing between revenues and expenses, again throughout the life cycle of the project. And in the final semester or final year, the focus will be on the slanging related kind of cash inflow that you might very well generate. Project evaluation requires defining an economic project life. May be different from physical asset because of technological obsolescence, market changes, etc., etc. And the overall cash flow projections of any organization should be very much in line with the expected operational life of the investment as such. Okay. So let's look at some basic conceptual element before we progress further. A financial analyst is evaluating a project that uses an existing building owned by the company. The building could alternatively be rented out for $5 million per year. How should this be treated in project appraisal? Are you getting the question? Evaluating a project that uses an existing building owned by the company. The building could alternatively be rented out for 5 million per year. How should this be treated?
So opportunity cost of 5 million per year.
Correct. It's an opportunity cost of 5 million per year. A project requires 2 million additional working capital at the start, which will be fully recovered at the end of the project after 5 years. How should this be treated in a project cash flow?
Uh, so cash outflow at project start and inflow at project end.
You are very much true. Project cash flow at outflow at the beginning of the project, and it should be treated as inflow because it is like fully recovered at the end of the project after 5 years. Okay. So let me just take a small pause of 5 minutes. We'll again reassemble.
Yes, sir.
Now let's look at the next module. So the discounting frameworks and the different appraisal techniques to arrive at your capital appraisal related decision. Now, discounting is something which we have already talked about. Future cash flows converting into the equivalent present value so that you can compare, right? You can very well compare the cash flows that are occurring at different points in time. That is the major intention behind doing discounting. The rate at which, at what rate, because we said FPV equal to FV divided by 1 plus R to the power N. Now, what is this rate? That rate is called discounting rate, which is nothing but it's the opportunity cost of capital, which is typically representing the return that the investors could earn if they are investing in some alternate investments with the same amount of risk. That is what is typically being understood as the discounting rate. So when you're discounting rate, it will typically talk about when you are considering the discounting rate. Obviously, you are taking into consideration the time value of money. You are also taking into consideration the investment risk and the required rate of return as such. So basically, this is the formula as we have said. The cash flow at time t divided by 1 plus r to the power t. Cash flow that is expected at a future date. And we are also looking at the discount rate is R and T is the time period. Now, when you are selecting the appropriate discount rate, we use this concept called weighted average cost of capital WACC, which is nothing but what is the cost of equity capital, what is the cost of debt financing, and what is the risk profile specific to the project. These are the three major things that are considered. So, depending on what is the value of the equity, market value of the equity as a proportion of the total value of the firm, what is the market value of the debt as a proportion of the total value of the firm. So value of the firm is nothing but value of the equity plus value of debt. Out of that, what is the value of equity? What proportion is the value of equity? What proportion is the value of debt? So it is nothing but weightage of equity capital multiplied by return on equity or cost of equity plus weightage of debt financing or debt capital multiplied by the cost of debt. Now, cost of debt actually has a benefit in terms of the tax advantage. Earlier, we have seen with the depreciation, with higher depreciation, you will get a tax benefit. Similar kind of a thing is coming here with a higher tax. I mean, with a higher debt also, you pay more interest, and because of that more interest also, you will get a tax benefit, right? So if you are having a high project risk, obviously your discount rate should be higher, because obviously the saying is, if you are investing, if you are coming forward to invest in a high risky project, obviously the major motivation for someone to invest in a high risky project is the expectation that you will get a higher return. So to compensate those kind of investors, you may want to provide a higher, larger discount rate as such. Right. So that is what are some of the discounting related principles that will come in handy. Then net present value. Now we are using some techniques, the different appraisal techniques. In this slide, I'll talk about net present value. In the next slide, we'll talk about internal rate of return. Right. In the next slide, we'll talk about the discounted payback period or payback period. So these are different capital appraisal techniques. Difference between the present values of PV of future cash inflows minus PV of future cash outflows. That is what you call as your net present value. And if at all the net present value is positive, we say you accept the project because it creates overall value. If the net present value is exactly equal to zero, you are indifferent whether to accept the project or to reject the project. You are not much bothered about what decision to take. And at the same time, if your NPV is negative, you reject the project as such. Right? This is the advantage of NPV. You look at all your future cash inflows, you bring them to the present value. You look at all your future cash outflows, you bring them to the present value. You subtract future present value of the future cash outflows from the present value of the future cash inflows. That is what will give you your NPV. Depending on whether it is positive, negative, or zero, you accept, reject, or stay indifferent. Here, time value of money is being taken into consideration because all the cash flows are discounted to arrive at the present value. Right? And you are using all the cash flows across the entire life of the project. And it is directly linked to the value creation. Directly linked to the value creation. And that is the reason, that's a clear advantage of this method. But how much accurately you are estimating the discount rate, because earlier we talked about I need weightage of equity, cost of equity, weightage of debt capital, cost of debt capital, what is the tax benefit that I would be getting because of that. That entire thing will lead me to finding out the proper discount rate. And if my cash flows are not forecasted properly, this method will not give me any kind of an advantage. So some of the positives and negatives as such associated with this mechanism. Then the next important framework that we are appraisal techniques that we are discussing is the internal rate of return. So it is exactly the same thing. You find out the net present value, whatever you are getting. Right now, you won't put, you will take R, which is the discount rate, as uncertain. You don't know, you are not computing the discount rate here. Right? You are leaving it as R. And you make the NPV value as 0. It means you take different values of R. For what value of R, for what discount rate, the NPV of the project is becoming 0. that rate, that discount rate where the NPV is exactly becoming equal to 0 is what is called as my annualized rate of return that is generated by project, which is otherwise called as the internal rate of return. So if at all the IRR that I am generating is greater than my anticipated rate of return or my required rate of return, you go ahead, because it is exceeding the expectation, you go ahead and accept the project. However, if the internal rate of return is falling short of the required rate of return, then you go ahead and reject the project, right? So if at all the project is having, we got, when I equated NPV equal to 0, let's say I got an IRR of 14%, but let's say my required rate of return or cost of capital is 10%, then obviously 4% excess return. So basically you go ahead and accept the project as such, right? So the whole evaluation of IRR is based on the percentage terms, not in the rupee terms or in the dollar terms. You can very well compare the different projects with similar scales as such. But because of this NPV being equated to 0 in some cases, so this is as good as solving for the root of the equation. Now this equation sometimes may become more and more complex, where you will get multiple roots, and sometimes there could be because of this multiple root means multiple IRRs. Some of them may be positive, some of them may be negative. So multiple IRR problem. So you don't even know uh, when which IRR you should go with, especially when your cash flow is changing multiple times. You will get into a multiple IRR kind of a scenario. And this method very clearly assumes that all the intermediate cash flows that you are getting from your investment, you are successfully able to reinvest them at the IRR level, at that IRR rate of return itself. In case you are not able to invest at the IRR rate, then probably your model is becoming slightly, I mean, it's not reliable as such, right? And it may lead to incorrect decisions when you are trying to compare mutually exclusive projects or the projects with very different sizes, different durations, etc. So normally from a practitioner's perspective, what we say is don't use IRR in isolation. Let NPV be your primary tool for evaluating the project, but let IRR be looked at as an additional measure over and above the NPV as such. Okay. Then the next technique that we are talking about is the payback period and the discounted payback period. So these two are typically called as liquidity focused measures. Payback period is a very simple measure. How much time, or probably how many years, how many months required for the cumulative project cash inflows to recover the initial investment. So let's say I have invested 10,000 bucks initially, but right, in year one I'm getting 1,000. In year two I got 2,000. In year three I got 3,000. In year four I got 5,000. So to recover this 10,000, I took 3 years and slightly into the fourth year also. So in the year, it's almost like 4,000 out of 5,000 is what is the proportionate thing where my total cumulative has gone to 10,000. So that's where we say this is equal to 3.8 years. 4,000 by 5,000 is nothing but 0.8 years. So 3 years full and 0.8 year. That is what is the payback. Payback period is always mentioned in terms of time. It could be in terms of years, it could be in terms of months, etc. Time required for the cumulative project cash inflows to recover the initial investment. So initial investment divided by the annual cash inflow, especially if they are different, you cannot directly divide that as well. You have to plan something like this. Projects with a shorter payback period are preferred. Obviously, if in a particular project, you are able to recover within 2 years, whereas this project took almost 8 years, then obviously the second project is much more, the first project is much more preferred compared to the second project as such. Right? Shorter payback periods are preferred, particularly under the liquidity constraint. Now, this method is very easy to understand. It focuses on getting back whatever I have invested, right? The liquidity risk. So when the future cash flows are highly uncertain, this method is going to be a very good method as such. And the major limitation is after this. Now, let's say after this, I will get in the 5th year, I am getting some 6,000. This 6,000 is nowhere considered in the computation of payback period. After the payback period, whatever the cash flows that are coming, they are typically not being at all. And there is no concept of time value of money in this computation. That is what is a major limitation associated with this method. On the other side, when you look at the discounted payback method, it's exactly similar to the payback period. The only difference is instead of taking these future cash flows, 1,000, 2,000, 3,000, 5,000, as it is, they are discounted. The present value of this 1,000, present value of this 2,000, present value of this 3,000. So it improves the traditional payback method by discounting the cash flows before calculating the recovery time. Right? Discount each project cash flow using the required rate of return, which cumulative discounted cash flows equal to the initial investment. So the same thing, but now instead of using 1,000, I will discount this 1,000. Probably I'll get it as 900 only. And after discounting, I will try to equate it to the overall 10,000 as such. And because of that, you will incorporate the time value of money, and probably this is much more a better measure of capital recovery related risk. However, again, in this case also, the 6,000 that you are going to get after the payment period, after the payback period, is completely ignored. You may get a very high value there, but it is still being ignored, and it does not directly measure the value creation. So this is also one more kind of a method that you may want to use. So we have discussed about NPV, IRR, payback period, discounted payback period. And we also have one more method called profitability index, which is almost similar to the NPV mechanism itself. The profitability index is actually nothing but the present value of the cash inflows divided by, I think my formulas did not come out properly, initial investment. So whereas in NPV, it is like present value of cash inflows minus present value of cash outflows. Yeah. So, or probably this itself could be called as initial investment. So you could see that there is not much of a difference between these two methods, right? Ratio of the present value of the future cash inflows to the initial investment. Normally, the acceptance or decision kind of a rule is if the PI is greater than 1, you accept the project. Less than 1, you reject the project. Equal to 1, you are indifferent. You can take your own decision. So normally when you look at the PE, we talk about the value that is being created by this project per 1 unit of investment. So if it is value of 1.25, you may say 1.25 rupees of value is generated for every 1 rupee value that you have invested. That is another metric called profitability index. Now, we also need to understand something called capital rationing. Obviously, every business, every company will have limited funds only that are available for investing, right? Which means I have to prioritize which project do I need to take up. I can't take up all the projects. I don't have unlimited access to the projects. I may have to really plan around with my investments as such, right? Now, the profitability index is very, very useful when you have your capital constraints and you have to provide the ranking for your projects, because instead of taking NPV, a profitability index will tell you for every 1 rupee of investment you are making in a particular project, how much is the return that you are getting in that project per se. Right. So you can calculate the PI for all the potential projects. You look at ranking it from the higher in the descending order, and probably until your capital budget is exhausted, you can select whatever is the number of projects that you can take up. And that is what will maximize the total value created under the limited capital. So compared to all the other approaches, this approach will be more suitable. And when you are evaluating multiple small and medium investment opportunities, this will come in more and more handy as well. But on the other side, the limitation is it may not produce optimal decisions if the projects are mutually exclusive, right? If you take up one project, you should not take up another project. Either you take this project or this project. If such a kind of mutually exclusive projects are existing, then you cannot take these kind of mutually exclusive projects. And NPV is the preferred criteria for the overall value maximization. If your focus is more towards the overall value maximization, then NPV is the most appropriate kind of an approach as such. Okay, before we move on to the next one, we will look at this particular conceptual checker. A project has an NPV of 3 million at the firm's cost of capital of 10%. What does this indicate?
So the project increases firm value by 3 million at least.
Okay, great. A firm faces capital constraint and must choose among multiple independent projects. Which metric is most useful for prioritizing projects when investment funds are limited?
They should go to the profitability index.
Profitability index. Just now we discussed about it. Great. Now let's move on to our next module in this capital project appraisal. So we will also try to understand a few important elements in the form of risk, sensitivity, and the decision related integration. So three important processes, right? Now, uncertainty. We have been talking about it, right? Because most of the capital projects, the cash flows are very, very uncertain. They depend on the future economic and operational conditions. So you are not clear on what is the value associated with each of these projects. Major source of uncertainties. So I'm listing out all the different sources of uncertainty here. One is the market risk. The demand can change in the future, right? The pricing might change in the future. Competition scenario might change in the future. And you are expecting, let's say, lower than the expected sales of the project. And because of that, overall revenues might go down, and that could create a negative NPV for you, or your profitability is not as expected by the NPV. Very much possible. Or I could be exposed to a cost risk. My inputs, my raw materials will become very expensive. There's a lot of volatility in the cost. Probably my because I'm talking about a 5-year project, 10-year project. So initially I made some assumption, but probably the wages, the salaries that I have to pay to my staff are more than what I have expected because of various reasons. Or any other operational expenses also have typically gone up because of very high inflation. Overall, my project costs also have gone up. And because of that also, my profitability as per the expectation. Similarly, technological risk, right? The technology that I am using has become very much outdated, obsolescence, and because of that, the project benefits also have gone down, which again will have impact on the revenues and hence your future cash flows as such. And similarly, you could be exposed to regulatory risk. Probably a tax policy would have changed. And because of that, I might end up paying more taxes, which would again impact my cash flows. Compliance requirement, I am asked to implement some more additional policies of compliance, which also is increasing my cash flows. All this stuff, right? Probably in insurance, banking, all these industries, the regulatory compliance kind of aspects sometimes may cost very, very huge. Then macroeconomic changes, probably the interest rates have changed quite drastically. The inflation has gone up quite drastically. The exchange rates have moved very much higher compared to the expectation. So all these are directly influencing the discount rates and the investment related returns altogether. And finally, there is an operational risk also, which could probably the project got delayed. You may have to pay a penalty. The costs have typically gone up. And because of all these things also, you might end up paying more and your profitability might be very much affected. Your cash flows might be very much affected. Now, all these are sources of uncertainty. Now, which means, how do I really look at handling that uncertainty? For that, what we say is better to do some sensitivity analysis. How the change in one key variable, we have talked about so many variables in the previous slide, how the change in one key variable is affecting the overall outcome, which means if I change my sales volume to some extent, how is my IRR affected? How is my NPV affected? When the product price is changed to some extent, how is the NPV affected? Similarly, you can talk of when the operation costs go up by 5%, by how much extent is my NPV affected? If the because of the inflation rate, the discounting rate changes, and because of that, how much is the impact on my NPV, and so on. So you are identifying all your critical variables that are impacting the project risk, and you are trying to see what is the impact of each of these variables on the project outcome. It could be IRR, it could be NPV. Right? What is the change in NPV divided by what is the change in that particular variable? That is what will tell you what is the sensitivity. So if a small change in the variable produces a very large change in the NPV, then that particular project is very highly sensitive to that variable. So you may have to handle that in a much more effective manner. So that is how you use the sensitivity analysis. Equally important as a sensitivity analysis is the scenario analysis, which is instead of one key variable, you will look at multiple combinations of assumption. So you will change more than one variable, create one scenario. Right? You will say sales increased by 5%, product price increased by 2%, operating costs increased by 10%. You combine all that stuff and finally create one scenario. So you say one is a base case, most likely scenario, or very optimistic case, very favorable scenario, a pessimistic case, which is a very pessimistic kind of a scenario, and you will try to compute the NPV under all these scenarios where your multiple variables are changed simultaneously. In a sensitivity analysis, one variable is changed at a time, whereas in a scenario analysis, multiple variables are changed simultaneously. That is about the sensitivity and scenario analysis. Then we also use a very important, while discussing the risk, we use something called RADR, risk adjusted discount rate. And vis-a-vis the certainty equivalent. These are the two important approaches here, where I will find out the discounting rate here. I will adjust the discounting rate if the project is becoming more risky compared to my average project or less risky. So if the project is a very high risky project, I will increase the rate of return. I will increase the discounting rate. So this denominator R risk will now be like an adjusted, which will take into consideration the adjusted risk, the new risk that is coming in. And based on that, you will again compute your NPV. Very easy to implement, very widely used in corporate finance, right? But now, how much is that excess? How do I compute that excess? Once I know what is my excess, I can very well put it into that same NPV formula, and I will get my risk adjusted discount rate, NPV. But how much should be my excess risk premium? That becomes a very tough thing, right? And probably this risk also keeps changing with the time period, but this model will give uniform weightage to all the time periods as such. So there are some limitations by using this risk adjusted discount rate. However, there is an other approach which is called certainty equivalent kind of approach. Now, instead of adjusting the discount rate, which is the denominator, here we will adjust the numerator, which is the cash flows as such. So all the risky cash flows will be converted into risk-free kind of equivalent, which is nothing but you will take whatever is a particular factor called alpha, which is a certainty equivalent coefficient, which will be have a value between 0 to 1. The advantage is every time period can have a different value here, right? So you will always discount with the risk-free rate of return only. But the numerical, in the numerator, you will see certainty equivalent coming out for each of the cash flows, right? So the risk adjustment now is nowhere linked with the time value of money. All the denominator is discounted at the risk-free rate of return only. Now the numerator, the cash flows are changing, and it is conceptually consistent with the expected utility theory. But again, how do I compute the certainty equivalent? Again, that would be a tough stuff. So probably in both these approaches, you can incorporate the risk, right? You can modify your decisions based on the updated risk. But how do you compute them is a bigger challenge, and it requires a lot more assumptions to be made to do the computation. Then one more dimension, especially if I have to talk about the decision integration, is getting into what is called real option, right? Because when you look at into a traditional capital investment related decision, you have a fixed investment decision, right? You are investing a huge money into a capital project, which will give you benefit over the next 5 years, 10 years. Some kind of cash flows are generated. Now, which means you are locking yourself for that entire period, irrespective of whether the project is going to be successful or it can be a failure as well. Now, in case you put in the real options on the project, it means that you will have some flexibility. So, which means you are, instead of locking yourself completely, you can change your decisions over time. In case that particular project allows for real, you can very well change your decisions over time. Some of the common decisions are you can delay, right? Until the uncertainty is resolved, you can postpone your investment. You can delay your investment. Or you can have an option to expand, right? So some projects may be scaled up to capture the additional opportunities. So these are some kind of flexibilities. Option to abandon. You can drop off the project also if after 1 year or 2 years you find that the project is unfavorable. Or you can even switch, right? Depending on the market conditions, etc. So which means they can create additional strategic value beyond what is being created by the standard NPV. So that's where we say if there is a real option, you will always find that the total project value is nothing but the NPV plus the value of the real option. So especially where there is a lot of uncertainty, especially in technology investments, where you don't know what could be the outcome at all, natural resource kind of projects, etc., R&D related projects, at some point you have to take a call whether you should go forward or you want to drop, abandon the project. So this is where the real options come into picture more and more handy. And finally, how do I integrate my appraisal into the actuarial decision making and the enterprise risk management framework? You have to integrate the whole project appraisal concept that we have discussed. Capital allocation related strategies you have to integrate. They have to be integrated into the risk appetite related frameworks, solvency related requirements, etc., etc. So, which means, what do I mean by integration here? At the stage of risk identification, right? You are identifying what are the different risks. I listed out the 6 major kinds of risks that can come up. So, all the risks that are associated with the project. Then, how the investment decisions are affecting the available economic capital. And I should ensure that the capital projects do not compromise regulatory solvency margins at all. Long-term business strategy is a very, very important aspect that needs to be looked at. And the projects must be evaluated from the broader asset and liability structure of the organization. So overall, what we are saying is the integration of the capital project appraisal into the actuarial decision making is a very, very important necessity as such. So yeah, with that, I think we can wind up this session for today. We'll just look at this conceptual checkers. An analyst tests how NPV changes when sales volume is increased or decreased by 10%. Variables remain constant. Which analytical technique is being applied? When only one variable is changed, and accordingly you are looking at what is the performance of the output, it is called sensitivity analysis. So probably we are looking at sensitivity analysis here. A firm delays investing in a renewable energy project, delays investing until regulatory clarity improves, even though the project currently has a positive NPV. Which concept best explains this strategic behavior?
Real options value.
Real option. Different options to delay, to abandon, to expand. All that is coming because of real options as such. Okay. All right. With this, we will conclude this particular session today, and we'll again catch up at a later point as such in our tomorrow's class as such. Thank you very much for listening to this session. Thank you. Take care. Bye-bye.
Thank you, sir.